In July 2025, President Trump shocked North America by imposing a sweeping 30% tariff on Canadian and Mexican imports: steel, auto parts, copper, lithium batteries, the backbone of continental trade. The move shattered the USMCA, sending shockwaves through boardrooms and governments from Ottawa to Mexico City. Instead of retaliating with tariffs, Mexican President Sheinbaum and Canadian Prime Minister Carney unveiled a $120 billion Northern Corridor, a bold network of rail and sea routes to bypass the U.S. entirely. This was more than a counterpunch. It was a declaration of economic independence, signaling that North American trade could reconfigure itself around U.S. obstruction. In Mexico, industrial giants like Carlos Slim rallied behind the project, while Canada accelerated its Pacific port expansions. The message: if the U.S. builds a tariff wall, its neighbors will build a bridge around it. The corridor directly challenged the assumption that all North American trade must flow through the U.S. heartland. In March 2025 alone, $144.8 billion in freight crossed North American borders, most of it through U.S. gateways now threatened by the new tariffs. Ironically, the U.S. move to protect its dominance catalyzed the very outcome it feared: a diminished role in its own backyard. The Northern Corridor isn't just a road or railway, it's a multimodal logistics network designed to reroute $69 billion in annual Canada-Mexico trade away from the U.S. Its Pacific Shortlink Rail connects Mexico's industrial north directly to Canada's Prince Rupert Port, bypassing U.S. territory and tariffs. The Great Lakes Flow Ring, a new sea route, lets Canadian raw materials travel down the Atlantic and into the Gulf of Mexico, docking at Veracruz, never touching U.S. soil. These routes insulate high-value goods from American tariffs and customs, transforming just-in-time manufacturing for both countries. By 2026, planners expect the corridor to divert a significant share of the $138 billion in annual Canada-Mexico trade. The goal, not just to shift existing trade, but to capture future growth and create a resilient, self-sufficient ecosystem. The U.S. is no longer the indispensable land bridge, it's now an obstacle to be navigated around. This reimagining of North American geography is already reshaping supply chains. The corridor's long-term implications are only beginning to be understood. For Canada and Mexico, it's a new era of economic independence. The corridor's success hinges on more than new routes. It's powered by a digital revolution. A blockchain-based smart manifest links Canadian and Mexican customs in real time, pre-clearing shipments before they even leave the factory or port. This frictionless border slashes costs and eliminates delays, making shipping via the corridor $34 per ton cheaper than U.S. routes. Billions in public and private capital are rapidly upgrading rail lines, ports, and fleets. Canada's Export Development Bank and Mexico's Bancomext have pledged over $29 billion to the project. The synergy of digital and physical infrastructure means a lithium battery shipment from Sonora can be tracked, cleared, and delivered to Prince Rupert without a single U.S. checkpoint. The result, a logistics model for the 21st century, faster, cheaper, and more secure. The U.S. is left watching as its neighbors leap ahead. The Northern Corridor is a gut punch to the U.S. logistics sector. Rerouted trade is projected to slash U.S. inland cargo traffic by 27%, hitting major hubs like Chicago and Buffalo hardest. The U.S. Treasury stands to lose $3.5 billion annually in border fees and customs duties as crossings like Laredo and Detroit see traffic dry up. For American workers, truckers, rail staff, warehouse crews, the impact is direct: fewer jobs, more layoffs, and economic hardship in already struggling communities. The Port of Buffalo, once reliant on Canadian steel, faces a sharp decline as goods reroute via the Atlantic. The corridor effectively cuts U.S. workers out of the supply chain. The total economic blow: $120 billion lost in just 2 years. The tariffs meant to protect American jobs have triggered a strategic realignment that leaves the U.S. on the losing end. The law of unintended consequences is playing out on a continental scale. Nowhere is the shock more acute than in Detroit. The new tariffs and trade bypass threaten to sever Michigan's vital cross-border supply chains, putting the state's economy at risk. By April 2025, duties on Canadian imports into Michigan had skyrocketed, and vehicle exports to Canada plummeted. The corridor cements this disruption, offering automakers a permanent lower-cost alternative for sourcing parts outside the U.S. Analysts project. Detroit could lose up to 360,000 vehicles in annual production and 108,000 jobs, wiping out $12.7 billion in regional income. Major players like GM and Biotech EV are already building a non-US supply chain, leveraging the corridor to assemble vehicles for North America and beyond. For Detroit, the industry that defined its identity is now charting a future that bypasses its factory gates. The Motor City faces an existential threat. The Northern Corridor is reshaping the global EV supply chain, forging a direct link between Mexico's lithium battery hubs and Canada's mineral wealth, leaving the US on the sidelines. Cheaper, high-quality batteries from Monterrey now flow tariff-free to Canadian assembly plants, giving Canadian and Mexican automakers a decisive cost edge. The Biden administration's push to onshore battery production is undercut by Trump's tariffs, making US plants less competitive. Projects like a Texas battery facility now face an uncertain future as raw materials are diverted north. US automakers must pay steep tariffs or be left behind as competitors leverage the corridor. GM's move to establish a non-US supply chain signals the industry's new direction. The corridor isn't just about dodging tariffs, it's about building a resilient, vertically integrated EV powerhouse. By combining Mexico's lithium and manufacturing with Canada's clean energy and minerals, the two nations are creating a global force in EVs. The US, once the leader, now risks becoming a bystander in the North American EV revolution. The new axis is here to stay. The corridor is more than trade. It's a green industrial strategy. Canada's landmark LNG deal with Mexico diverts 5 million tons of gas annually from California to power Mexico's factories, raising US energy prices and boosting Mexico's industrial growth. The corridor prioritizes low-emission materials, green steel from Canada, advanced batteries from Mexico, and electrified logistics to minimize its carbon footprint. This is a calculated play for the European market, where the EU's carbon border adjustment mechanism rewards low-carbon imports. By building a verifiably green supply chain, Canada and Mexico aim for tariff-free access to Europe. The partnership also opens the door to a joint carbon credit market, attracting investment and accelerating the transition to a low-carbon economy. The corridor becomes a platform for comprehensive green policy, positioning Canada and Mexico as a forward-looking bloc. The US risks being left behind in the race for sustainable trade. Is the corridor a temporary fix or a permanent fixture? All signs point to permanence. Over $30 billion in initial investment from Canada and Mexico signals a long-term commitment. Once businesses reconfigure supply chains and sign long-term contracts, reverting to old US routes becomes costly and unlikely, even if tariffs are repealed. The corridor is more than a bypass. It's an integrated ecosystem of clean energy, digital customs, and low-carbon manufacturing. This synergy makes the Canada-Mexico partnership globally competitive, especially in Europe. The US must now face a new reality. It's no longer the indispensable hub of North American commerce. The corridor is quickly becoming concrete steel and sovereign ambition. Capital and commerce, like water, find the path of least resistance. And now, that path runs around the United States. The Northern Corridor marks a tectonic shift in North American trade, challenging the US-centric model of the past. The continent's future is now defined by open questions. Is the era of a single, integrated market over? Can the US compete by modernizing its infrastructure, or will it double down on protectionism and accept a fractured continent? The USMCA itself is being bypassed by two of its three signatories, raising doubts about its relevance. The US may soon have to negotiate its way back into a supply chain it once dominated. The corridor is a lesson in how protectionism can trigger rapid, unexpected realignments, creating new winners and losers. In trying to shield its industries, the US may have accelerated its own economic isolation. The future of North American trade is now one of competition and bifurcation. The US is no longer the default pathway to prosperity, but just one of several competing routes in a redrawn economic map.